Hello and welcome to the College Investor Audio Show. We are so glad that you're here today. Just honored that you chose to listen to the podcast and also subscribe. So you're always up to date anytime we post new content, and we really do regularly. You can hit subscribe button on the podcast. You can also share this with your friends and family, whoever this might affect, especially if you have an HSA, because today's topic, what actually happens to this HSA thing when you die? Before I get started, though, please consider going to thecollegeinvestor.com. We have tons and tons of resources and articles for you. You can dive deep into this article that we're talking about today. They're all at thecollegeinvestor.com. Also, follow us. We're pretty much anywhere you are on social media. Just search for the words The College Investor, and you'll probably find us. We'd love to get to know you. Okay, so HSA. An HSA is arguably the best tax-advantaged account available in the United States. With an HSA, a health savings account, contributions and qualified withdrawals are tax-free, baby, which makes an HSA perhaps the only way you can earn, invest, and spend without paying taxes. A Roth IRA is the other thing. While we don't usually like to think about this, 100% of people do die. So savvy financial planners want to know what happens to their HSAs when they pass. Here's an in-depth look at what happens so you know how to include your HSA in your estate plan. Okay, a little snapshot here. Your HSA might be taxable when it's inherited by your beneficiaries, just depending on whether the beneficiary is your spouse or somebody else. If your beneficiary is your spouse, he or she can inherit your HSA without any taxes. So the account simply just becomes theirs, tax-free. If they have another HSA, they can likely roll it over into their HSA for simplicity and then have both of them on one account. But if not, they can just inherit the account as is. Wonderful. When the spouse incurs qualified medical expenses, they can withdraw from that IRA tax-free, or HSA rather, because of the major tax benefits of the account, which we're going to get into in just a bit. This is the ideal scenario for your HSA when you die. Now, what if your HSA or your beneficiary is not your spouse? Uncle Sam, we got to love him, right? Will want a little cut of that if you don't have a spouse or you want to leave your HSA to someone else. Whether you leave the balance to your estate, your kids, favorite charitable organization, or anybody else, the inherited HSA is treated as regular income. Blech. Let's a quick and easy example here. If you leave your HSA with $100,000 to your kid, who has a 25% tax rate, they would have to pay $25,000 in taxes. Government, am I right? That leaves them with $75,000 instead of $100,000. So because of this significant cost, leaving an HSA to a spouse is always, always, always better. If possible, of course, but if you're unmarried, the beneficiary or beneficiaries should be prepared to pay taxes on the inherited HSA. So, all right, you might be thinking, all right, what's an HSA again? If you're unfamiliar with this, just a closer look, here's how they work. HSA stands for Health Savings Account, and as the name suggests, they're intended for healthcare-related costs. And they have the best tax treatment around. You can only have an HSA if you have the right type of insurance plan. If you do, you can contribute to the account pre-tax, meaning your total annual contributions lower your total taxes in the year you contribute. Then, if you withdraw to cover the cost of a doctor's visit or prescription medication or a hospital stay, any of that, your withdrawals are tax-free, including any capital gains. This really is an unbeatable deal for taxes. Retirement and education accounts typically allow you to contribute tax-free or withdraw tax-free, but you're going to have to choose one or the other. With an HSA, you don't have to pay taxes at all if you follow the rules. Balances can be held in a savings account or invested in mutual funds, ETFs, stocks, and other commonly available investments from major brokerage firms. If you have an HSA and want to make the most of it, You can check out our list of the best HSA accounts at thecollegeinvestor.com. The IRS limits the amount you can contribute to an HSA. Of course they do. The IRS likes to limit our fun, don't they? And the limit tends to go up a little bit every year. Here's a glance at the 2025 HSA contribution limits. This changes every year, by the way, so just take this with a grain of salt. Contribution limits for 2025 for an individual is $4,300. For a family is $8,550. Let's continue on our theme of limiting things, thanks IRS, with is there any limitation on who can get an HSA? Well, HSA accounts are only available to individuals and families with a high-deductible health plan, HDHP. Specific limits on what constitutes an HDHP change annually, of course. So just find the IRS's latest information. But for 2025, the requirements for a high-deductible health plan are this. The minimum deductible for an individual must be $1,650, and for a family, $3,300. The maximum out-of-pocket for an individual is $8,300, woof! And for a family, $16,600, yowza. All right, so here's how to turn an HSA into an epic retirement account. Yes, this whole thing is intended for healthcare expenses, but you can take advantage of an interesting loophole that allows you to effectively turn your HSA into a retirement account. You can only make tax-free withdrawals from an HSA to cover healthcare stuff. But there's no rule that you have to pay directly from the HSA or reimburse yourself right away. With a self-directed HSA, you can build up a long list of expenses and reimburse yourself well into the future, even decades into the future. What? I'm using a database I built myself in Airtable to track every HSA-eligible expense. I keep the receipts in a folder per year for paper receipts, or in an email inbox when I pay and receive the receipts online. You can also use like a spreadsheet, a purpose-built app, a tracker built into your HSA provider's website or app, or anywhere else that's most convenient to you. I have more than $19,000 in expenses I've added up for my family over the years, and I can tap into tax-free anytime I need to. But with tax-free investment growth, I'd rather, avoid withdrawing from my HSA unless absolutely necessary. Do not squander a tax-free opportunity. Keep the IRS at bay with their limiting things and that Uncle Sam finger pointing at you. With such a massive opportunity to save on taxes, anyone eligible for a health savings account is likely best off taking advantage of this. But now you know what happens to your HSA when you die. So just make sure to keep your beneficiaries updated with your HSA and all accounts to ensure they go where you want if you pass away. That is our quick hit and show for today. If you want to find out more about HSAs and how to take advantage of tax-free things and loopholes in the IRS's system of limitations and stealing, you can find out more. I love the IRS, can't you tell? You can find out more at thecollegeinvestor.com. You can also follow us and like us and subscribe to us or whatever it is all over social media. Just type in the words The College Investor and you'll find us. We'd love to get to know you and help you out on your money journey. Thank you so much for stopping by today, and we will talk to you again real soon.